Good Thursday afternoon, investors and traders, Finom Group members. This is our weekly State of the Market by Finom Group. I am your host, Seth Golden. As we often do, let's start out our weekly State of the Market with a famous quote from Jack Bogle. Greatest enemies of the equity investor are expenses and emotions. Do you concur? I concur. I forget what movie that was from, but it's Catch Me If You Can. Catch Me If You Can with Leonardo DiCaprio. Do you concur, doctor? It was a good line. Anyways, we came into this trading week, well, with a lot of skepticism, pessimism from many investors, analysts, strategists around the web, in the marketplace, around the marketplace, in the financial media, outside the financial media. We just had a bad end to the previous week, down 2 days in a row, and coming into this week, it's set up for, basically some more downside given that pessimism, maybe a little bit of fear as the volatility in the markets were rising. Bond market volatility was also ticking higher. We had yields under pressure, equities under pressure. There wasn't much to look forward to unless your glass was half full. And that's the way you see the market, through an optimist prism, if you will, glass being half full as opposed to half empty. In our weekly research report from Sunday, we had reasons to be optimistic. Not just, prices being on sale, right? When stocks go on sale, as I always say, that's your best friend. Like, why are you angry? Why are you saddened? Why are you pessimistic when that favorite stock of yours, when that favorite ETF of yours has gone on sale and given you the opportunity to, pick it up at a deeper value? That's the way I see the market. And we were also looking in our weekly research report, which is delivered every Sunday to our Finom Group subscribers. We were looking at the percentage of New York Stock Exchange stocks above their 200-day moving average relative to New York Stock Exchange stocks trading above their 50-day moving average. And we took this chart back a good 5 years, narrowed it down to 3 years here in this particular rendering. And you can see every time it gets above 1.5 reading here on this relative performance ratio, it's a breadth indicator, if you will. Every time it gets above 1.5, and we finished a little bit above 2.0 last week. 2.09 last week. But every time we get up to these levels in a normal cyclical bull market, we're usually near the end of a price consolidation at the index level. We're usually near the end. We're not usually at the beginning of price consolidation. So this is one of the reasons why we were somewhat optimistic coming into this trading week. We finished the week at the highest level we have seen, since leading up to the pandemic bear market. We've seen spikes in this relative performance ratio in the past, and they've all delivered very good buying opportunities. It's one of the reasons why at the end of our research report this last weekend, I said, I don't desire to leave members without some indication of my buy the dip shopping list. I would encourage investors to juxtapose what's on the list with what has been outlined in this week's analysis and our market outlook that we deliver within our report. So here was my buy the dip shopping list. JP Morgan. And JP Morgan fell down into the 146s or even 145s maybe on Monday, right? Because we had that bawoosh on Monday, that more downside, more bad breath. We needed to see that trough. But at any point in time, if you had bought on Monday, if you had bought that dip, you would have done very well in JP Morgan. Alibaba, no different. Semiconductors, no different. Apple, Walmart, Verizon, and the small cap ETF, which actually outperformed everything on my list here. Did it seem like I was pessimistic? Did it seem like I was shying away from cheaper prices? I certainly was not. And we did buy the dip in Apple. We did buy the dip in Walmart. We did buy the dip in Verizon. In fact, coming in, this is our spreadsheet of our weekly trades. You know, here's 719, Walmart, Apple, TJ Maxx, UVXY, Verizon, we bought and sold twice. VXX, we shorted volatility. Apple. We've completed 8 trades this week simply by executing our game plan, which was to buy the dip, predicated upon all the analysis, and this is not all the analysis. We looked at many different breadth metrics, and a lot of them were showing washed out or near washout levels. That was our game plan. As I often say, if you approach the market or engage the market with a negative or pessimistic bias, you'll often be on the wrong side of the trade just based on natural long-term price action, which is markets go up over time. Looking, what happened on Monday, here's a chart of the S&P 500, is nothing different than what we have seen in the past during these consolidation points. And that's simply the S&P 500 checking down or checking back, revisiting this 50-day moving average. It queued off of that on Monday and closed just above the 50-day moving average. What was also interesting is this line right here denotes, I think, 40 on the RSI. This chart was actually rendered by a friend of mine, Andrew Thrasher, of Thrasher Analytics. And you can see there's a lot of support here for the RSI, and there's a lot of support here for the S&P 500 itself at the 50-day moving average. Moving averages, support, it's price reference. The market likes to refer to previous, points throughout its history. Consolidated down to that 50-day, bounced right off of it, and since then we've had a nice 2-day rally. Over the last year, there have only been 2 times where the S&P 500 closed below its 50-day moving average and continued to decline meaningfully from there. Only twice over the last year. And you can see that was back here. Looks like September. Ooh. Yeah, that's September and October going into the election. That final week of October, I think it was, just before the election. And man alive, did we have a nice rally ever since. That's it. Twice we've closed below the 200-day moving average in the last year. In fact, this year, while we've checked back to it a number of times, we have not had 2 days, consecutive days of closings below the 50-day moving average either, obviously. So what doesn't show up here was we did actually close below the 50-day moving average here. But the reason why it doesn't register is because the only reason why we closed below it was because the 50-day moving average continued every week. The 50-day moving average in an uptrend is moving up with price. So even when price stalls out, it still has an upward bias. It's still traveling higher. We closed on a Friday just above the 50-day moving average, but because by Monday it was even higher because it's a time-based moving average, technically we closed below it the Friday before. And that's why it's not registering here in the Bespoke Investment Group chart. And that's why I say we haven't had 2 consecutive closing days below the 50-day moving average. Obviously, this can't keep going on forever, but in the short term, and until it doesn't work anymore, the buy the dippers will likely stick with what has worked. There's a strong market message here. It's consistent. If you've decided to be contrarian to the trend, you've literally not listened to the market's message. And if you position contrary to the trend, you've been your own worst enemy. Listen to the market's message. Now the chart here from Andrew Thrasher really just highlights what was indicated here by the support of the 14-day RSI for the S&P 500. The number of days the RSI has been above 40, it's 179 days now. It's a long time. It speaks to the trend. It speaks to momentum, obviously, and the strength of the momentum in the market. Looks like we haven't seen such levels since maybe 2003, 1995, 96. Yeah, 95 and 2004. And that led to more gains, folks. We know what happened from 95 to 99. We know what happened from 2004 up to 2007. A lot more gains. We've not yet had a 5% pullback. I know it seems like every week we revisit this theme of a 5% pullback. When is it going to come? It is very unusual for the S&P 500 to go this long. Today, I believe, is day 181 that we haven't had consecutive days without a 5% pullback. 181 consecutive trading days without a 5% pullback. The streak currently, well, as I wrote this, it was 180. The average year, so the average year sees 3. Here's the trend line. This goes all the way back to 1950. So going all the way back there, if you take the average of 5% declines in a year, it's 3. We average 5% declines every year. But you do have your off years here, 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 so on and so forth. None here, none here. That was 2017 right there. And this looks like 94, 95 right here. And when people say, well, the market's due, I often say, well, can you point me to, can you link me to the calendar that the market is supposed to abide by? Can you link me to that calendar? The market seasonality and things of that nature on any given year can, detract from the trend or the historical averages. We have to keep that in mind and be flexible with our approach to the market. Coming into this week, almost half of the S&P 500, we're talking about a 5% correction, talking about a 10% correction. The reality is that half of the S&P 500 was already down 10% or better, while the index was only less than 1% from a 52-week high as of Thursday, today. Most stocks had already corrected, but the index was being buoyed by the latest rally in the mega cap names. Remember that the index is cap weighted and the largest weighted stocks have actually been rallying. They've simply been holding up the S&P 500 while many stocks have corrected in price to a greater degree. You gotta think FanMag, right? Think FanMag. But here is that chart. The percent of S&P 500 down 10% or greater. Right now, 47.5% of stocks are 10% below, 10% or greater below their 52-week high. Market's already had a correction. It just hasn't had one at the index price level. It's been happening beneath the surface, so to speak, on an equal weighted basis. And if you look at the equal weighted S&P 500, it has had a nice pullback here. That has had a 5% plus pullback and since bounced as of the last couple of trading days. You can see that bounce here. It's trading in a pretty, narrow range here. This goes back to basically the end of April. At some point, it's either going to break out or it's going to break down in a cyclical bull market that you could argue began no more than a year and 3 months ago. We should see more upside, assuming that the economic conditions continue to proliferate into the coming year. Now, although breadth has certainly improved over the last 2 trading days, right, you would expect a pretty significant bounce in the percentage of stocks trading above their 50-day moving average, and they have bounced. But for the S&P 500, we still have barely less than 50% of stocks trading above their 50-day moving average. So it's had a nice bounce. We want to get to 50% or better. And essentially what this still denotes is that the S&P 500 is still vulnerable to some price correction or time correction, consolidation, if you will, because the percentage of stocks trading above their 50-day moving average is still relatively weak. I say relatively compared to where it has been, but it has deteriorated. Eventually, it caught up with the whole of the S&P 500. We saw some of that capitulation on Monday, but 2 straight days of very strong breadth in the market have resulted in the index getting back to within 1% of its all-time high. But again, we'd like to see stronger breadth on an absolute basis. Breadth did make a stand. As of Monday's close, breadth did make a stand. And since then, we've had 2 consecutive trading days of greater than 80% up volume in the NYSE. And that's what these notes here from Bank of America describe. In fact, we had a 290% up volume days for the NYSE in the month of July. We've actually had 3 now, if you include yesterday: 7.9, 7.20, and 7.21. We've had 3, 90%. Well, yesterday actually was only 83%. So above 80% volume, up volume, 3 times here in the month of July. And you can see when it comes to 90% up volume days for the NYSE, meaning that 90% of stocks have advancing volume, not declining volume, advancing volume. It's been very rare. We had a lot of clusters back here, in the early 2000s and just after the great financial crisis bottom into the new cyclical bull market. But since, let's say, 2014, 13, they've been few and far between. And we've had 2 of them here this month. What does that mean? Is there a signal there, right? That's the next question. The stack chart above, this is the S&P 500. In the top panel, the NYSE up volume is here in the bottom panel. It identifies the more recent 80% up volume days going back to 2018, this chart, back to 2018. So 80% we're using the threshold here, which is still extremely strong. And you can see the different times that it's gotten above 80%. Once here, 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 a couple times in here, and recently. More gains. This came after a dip, but then you get the up volume and a lot more gains. We had a nasty dip again, more gains. Of course, this was the pandemic crash. And then you get the surge in up or advancing volume on the NYSE. And again, you get a lot of more gains. It's conviction. It's people buying the dip in a very strong way. The S&P 500 forward returns indeed are usually positive. We looked at this study here just last week because we had this, because everybody keeps talking about a 5% correction. And we are just coming off this streak of new highs in the S&P 500, 7 consecutive days of new highs going back to the beginning of this month. And it's happened a couple handful of times here throughout history. I mean, 7 days in a row where the S&P 500 hits a new high. Forward-looking returns tend to be very strong, and the positivity rate is very strong as well. But what about the drawdowns, right? What about the drawdowns? The outlier here is a 6.83% drawdown. So it's possible, certainly. But the average drawdown of all these occurrences, higher 7 consecutive days for the S&P 500, new highs, is only a drawdown of 1.77% on average. For all of these different 5% correction and 10% correction calls, more than likely we're going to need a significant catalyst. So far, because everybody was blaming the Delta variant on, Monday's swoon in the market. It's Delta. It's the bond market telling us something about a weakening economy. 2 days later, all that's gone. I think the best take from that is, and while we do have headlines about the Delta variant and a spike in hospitalizations, a spike in infection rate, the market is sending you a message. That's not the catalyst. That's not the catalyst for maybe a bigger correction. Unless it really materializes and forces, government intervention, local municipalities reinstating social distancing measures, lockdowns, things of that sort. But the reality is there's no real appetite for that. We see what we got from it. It bought us time, which is a good thing because we got the vaccine. But we also have a smaller percentage of the population that's not vaccinated. So the reliance or the need for, local shutdowns seems rather improbable that we're going to go through that once again. All right, these studies here, percent of stocks above the 200-day falls below 80% for the first time in 3 months. So last Thursday, market down. Friday, market down. Monday, big bawoosh down. That took stocks, above their 50-day moving average and above their 200-day moving average much, much lower. So looking at this study, the percent of stocks above the 200-day falls below 80% for the first time in 3 months. That's what we want to know, what the forward returns might look like given this occurrence. It's not a lot of data points. I mean, there's only 6 times going back to 2000. It's only happened 6 times going back to 2000. But it doesn't suggest impending doom. The average return 2 weeks later is very scant. But if we go out a month later, we've got a 1% gain. 3 months, a bigger return. Look at the positivity rate, 83% of the time. It basically speaks to the probability that the recent 3.5% correction in the S&P 500 was nothing more than cleansing, just a little bit of cleansing, consolidation for time, more so than, gloom and doom price. The one negative return from this, out of the 6, there was one negative return, and that happened in 2011. Happened in 2011, where the S&P 500 actually fell 7% over the next 3 months. So this, only 6 occurrences since 2000. The one time the market was down was 2011. And over a 3-month period, it fell roughly 7%. All right, so what about the percent of stocks, that fell below 4, trading above their 50-day moving average, but that number fell below 40% for the first time in 3 months. All right, we just looked here. We came into today with 49.9% of stocks trading above their 50-day moving average, but it had gotten below 40%, just below that gray line there. I should be gray. That's all I see, so forgive me. I'm colorblind. Most of you know that by now, but for any of our new viewers, sharing something. All right, so the percent of stocks above the 50-day moving average falls below that 40% level for the first time in 3 months. The forward-looking returns over 2 weeks, over 1 month, over 3 months. The percent positivity rate, and we got a bigger sample size, right? 26. Percent positive doesn't vary very much. They're all in the high 60s range, which is good enough. We'd like it to be better. But again, mostly positive returns. And 6 months later, 80% of the time, the market is higher for an average return of 5.4%, when the percentage of stocks that are trading above the 50-day moving average falls below 40% for the first time in 3 months. What about that 50-day moving average for the S&P 500 itself? So we use the same study as we did here, but with the S&P 500 near its 50-day moving average. Does that, throw any monkey wrench into things? Well, not really. 2 weeks later, up, up. A month later, 3 months later, and that's the kind of percent positivity rate we like, 75%. It just feels like cleansing. And the data still does not support a 5% or greater pullback based on the quantitative studies we're looking at here. Don't want to leave out the NASDAQ, right? Because that went through its own consolidation as well. But based on the chart that we see here, high, came back right to that line around 14,212 to 14,175 for the NASDAQ. I mean, support is beautiful. Remember, moving averages, support, resistance, they're just reference points for price, check back points, if you will. And speaking of the NASDAQ breadth, because we talked a lot about the S&P 500, the percent of stocks above their 50-day moving average, coming into today's session, they did see a jump also in the NASDAQ, but coming into today's session, the jump was from 25% of stocks trading above their 50-day moving average in the NASDAQ to 38%. So it's even weaker, or it has that much more price sensitivity or vulnerability, given that we only have 38% of NASDAQ stocks trading above their 50-day moving average. It's a little bit more prone to, downside risk, if you will. And the downside risk may come. Again, we are looking at the cycle composite index from Ned Davis Research that we frequented over the last month, because we want to have the appropriate expectations for the path forward in the market so that we can game plan. We can position our portfolio if we are active and thinking about the near term or the next move in the market. We want to have appropriate expectations, and the cycle composite index lends itself favorably to holding appropriate expectations. As you can see here, pretty much we get a nice surge into the end of July, but August we get that swoon into September. We finally get a bit of a lift or a reprieve, if you will, relief, come the fourth quarter, and which tends to be one of the better quarters of the year, not just on any given year, but also on the first year of a new presidential cycle. The fourth quarter tends to do pretty well also. So there's still, again, we got weak breadth. We have a seasonal headwind, if you will, based on the composite index here. Be flexible with your game plan. Hold the right expectations. Make sure that you're positioned well. And we're moving, look, the market may go down. It doesn't mean the stocks in your portfolio won't. Or will, I should say. If you're a good stock picker, and we do see pressure, we do see volatility in the markets, we might see certain sectors that benefit from that. Safe havens, if you will. Defensive areas of the market. Tech, consumer staples, utilities, real estate, healthcare. Defensive areas of the market may outperform. Those more sensitive to the economic stresses that we might find as well. This is also, again, going back to 5% correction, market crash. Data Trek, and they're not calling for a market crash, don't get me wrong, but they are looking at the seasonality, and they're seeing also that volatility tends to pick up in this season. We tend to see volatility rise in the back half of July, about the third week of July into August. So in considering a market crash, which is not their call, but more of the probability of a 5% correction. As Data Trek says here, our magic number is a down 5% day for the S&P 500. One day. not a correction that lasts, a month or so and culminates, at a 5% magnitude, but a day. That's what they're contemplating here. I love it. And I'll show you why. That is a 5 standard deviation move. So solidly in the highly unusual, because a 1 day, 5% down day is highly unusual. But here's some color as they offer. Since 1957, the index on average gains a very small amount each day and has a 1% standard deviation around that mean. The statistically minded reader will know that a 5 sigma move should only occur once every 3.5 million days, but it happens far more frequently in stock markets because returns have fatter tails than a classic normal distribution. The last 10 years, or 2,400 trading days, have seen the S&P 500 move by plus 5% in a day on 5 separate occasions. That's just 10 years, that DataTrek is referring to. And they give all their dates here. Now we know a lot of that came in 2020. This chart right here goes all the way back to 1955. And it shows you all the 5% or greater 1 day down moves. 5% or greater. We had almost a 12% down move on March 16, 2020. 9.5% on the 12th of March, 2020. Before that, well, that was Black Monday, down 20%. But look at the next day. This is why I say I love this. If you want to give me a 1 day down move of 5% or greater, and I've got cash on the sidelines, give it to me. Give it to me. I don't want it repetitively, don't get me wrong, but the data says, look at this. The next day for the S&P 500, the average gain is 2.14%. The percent positivity rate is 81.5% of the time. In other words, if the market closes, you better be in there in the after hours or in the 5 minutes going into that close, buying maybe the index ETF or things of that nature, so that it's a direct correlation to this particular set of data. Because the percent positivity rate that we're going to be green the next day is very, very strong, and the return is a little more than 2% on average. Look at the move down 9.5% there on 3/12. The very next day, up 9.25%. Down 12% here, up 6% the next day. So give it to me. Give it to me. Tell me also when you give me that 5% down day that nothing's changed in the economic outlook or the trend in earnings, and I'll take that. I'll take that 5% down day. And I'll be loading. And yeah, I could be wrong 18.5% of the time. But I'm willing to take that chance. This is better than a lottery ticket. This is better than your odds at the lottery, folks. All right, some more pullback calls, if you will. But this is a bit more than that. This is a market crash call from David Hunter. He's got nearly 100,000 followers on Twitter. He's a 40-year veteran of markets. He's made a video of this pending market crash call, if you will, and he's looking for a 65 to 80% crash in the market. He first believes that the market can get to 4,700 and the NASDAQ gets to 17,000. He made this call back in February. Right now, it doesn't look too bad, especially for the S&P 500. NASDAQ's going to take it's going to take a move, obviously. But this latest call, well, this isn't just, the video was made a month ago, back in June. 65 to 80% market crash. Now, in an article that was penned in April, David Hunter also said he forecast a 40% market rally out of the pandemic lows. I put the link here for the article. Check it out at your leisure. Yeah, it's coming up here as well. Okay, we're good, we're good. So you can click on the article, read it, but within reading it, he says he sees a massive S&P 500 rally. Again, this was April of last year. We indeed did get a 40%, we had a 40% rally. The thing is, we had almost 100% rally in the S&P 500 off the bottom. You know, when you get to the end of that 40% call, what then? In my book, why make that kind of call in the first place? Like, you don't know. I mean, you get a 40% rally. There's something behind that. That's a freight train you don't want to step in front of. In my opinion, that was the wrong call. Again, but why even make such a call? These calls are somewhat nonsensical. You know, what's David's track record? He doesn't make a lot of these calls, don't get me wrong. But when he makes these crash calls, these bear markets or recession calls in the past, and he has made another one back in 2014, as you can see, this was the article that was penned, August 20, 2014. A bear market has begun. Here's the article, folks. Bear market has begun by David Hunter. I don't need to tell you really what happened, you know, after 2014. What I might need to tell you, though, is what led up to this call. And what led up to this call by David Hunter was 3 consecutive years of double-digit returns in the S&P 500. Double-digit returns. I think we only had one 10% correction during that time period here. You see how this works? Everybody's clamoring. We haven't had a 5% correction in 180 days. That must mean we're going to crash near term, right? That's how it works. People just start to get anxious. It can't go on like this forever. My probabilities of a market crash, given the duration of this particular cycle without a 5% correction, is actually better than average, right? Because we are ultimately going to get a 5% correction. It's just a matter of when. But just like from 2012 through 2014, when you don't have a meaningful correction and you're up double digits year after year after year, people make these kinds of calls. And that's what happened to David then. And he's doing the same thing again. It seems to me, and what's the definition of crazy? Well, the definition is you commit to the same action, but you expect a different outcome. From 2014 till 2019, we still higher, higher, higher. It took a year. It wasn't until, so he made this call in August of 2014. It wasn't until August of 2015 that we got like a 15% correction in the market that took us into 2016. But that's not a bear market. It's not a recession. And what came after that was just more and more gains for the S&P 500. 100,000 followers, though. Again, just because you're popular on Twitter, just because you have 40 plus years worth of experience, does not mean you're impervious to error. And again, what's the utility in these calls for you? That's the question you got to ask yourself. What is the utility in this call for you as an investor or trader? What can you do with it? To me, it reeks of look at me, look at me. I'm making a huge call. Apparently, a lot of people are looking at him. Remember, Michael Burry made a market crash call, about a month and a half ago also. Look at me, look at me. Michael Burry, the mortgage meltdown call that he made. So for me, what it all comes down to is earnings, folks. If you follow earnings, You don't need these kind of calls. I don't care, that he's also, suggested something favorable as well. 4,600 on the S&P, NASDAQ. That doesn't change my outlook. I don't use that to adjust or align my trading and investing regimen. I look at earnings. As earnings go, the market goes over time. That's how it works. That's why Larry Kudlow coined the phrase, earnings are the mother's milk of markets. Guidance raises already. Look at this. 15% of companies that have reported to date for the Q2 period have raised their guidance. Verizon just the other day raised its guidance after releasing earnings. Pepsi, Coca-Cola, all raising guidance, all reported within last week or so. Right now, this is a real-time snapshot, if you will, by FactSet data of the estimated earnings growth for the Q2 period. And it just keeps going higher, folks. Every single week, they're forced to ratchet the outlook higher. We came into this week with FactSet's previous publication of blended growth at 69%. Now it's 71.4% year over year earnings growth. Tech has not reported yet. FanMag has not reported yet, shy of Netflix, which slightly missed by, a nickel or so on earnings. You got the big companies coming up next week. You got Google, you got Microsoft, you got Apple, Amazon, Facebook, all reporting next week. What do you think this number is going to do when we're here next Thursday? Follow the earnings revisions, folks, because the market does. That's what the S&P 500 does. That's what the world markets do. And that's what the MSCI data is showing you. Here, the global equity market earnings revisions ratio has been moving up. It took this real big leap coming out of the pandemic, obviously. A little bit of it, and now it's re-accelerating to the upside. This is the MSCI World Market View. Earnings outlook, the S&P 500 correlation to direction of EPS. It's just another chart showing the same thing. As earnings go, so does the S&P 500. We had a big dip here because of earnings faltering, and we've since rallied as earnings have turned higher. Well, what about 2022? I mean, earnings can only get so good, right? It's a point, sure. We're setting a very high bar here in 2021, but when we look at Refinitive's 2022 estimates are tracking right now, the first quarter could be a little, because the comp is so high, 2.9% growth in Q1 of next year, but then we're at double digits again here, folks. And pretty much looking at double-digit earnings growth next year as well. What about taxes, right? What if they raise corporate tax? What if they raise the income tax? What if they raise the earned capital tax on investments? A lot of that is unlikely. We're going into a mid-cycle election year next year. It's going to be very difficult to pass tax legislation next year. It's tough to pass at any time, let alone an election year. You're a senator, you're a congressman. Do you want to go back to your constituents? Do you want to be known as the person who signed off on tax hikes? It's going to be very difficult. At best, they may be able to squeeze something marginally, but nothing that's going to be terribly impactful to the bottom line of S&P 500 companies. And that's all I have this week, folks. So right now, let's just check back in. I know we've been having some weird outages. Okay, it's gotten better. There were 28,000 websites that were down about at the beginning of our State of the Market video. It's all over the headlines. We saw the market dip as well. It's come back. Look at that. But we were down about 8-9 points on the S&P 500 as all of these are websites down, all these blinking, I don't know what color, but you see it, folks. We were at 28,000 and now it's only 18,000. I know that some of the brokerage firms were down as well. IB was down, Schwab was down. I don't know how many others, top of my head, I'm just saying. But maybe this was the opportunity that was needed here today for those dip buyers to get yet another shot in case they missed out on that swoon from Monday. So with that, thank you everybody again for joining me here on this week's State of the Market. Trade safely.